If you live in a condominium, new rules from Fannie Mae and Freddie Mac have the power to put your building on a financial blacklist. If your homeowners association fails to comply with these updated guidelines, your building will be classified as non-warrantable. A non-warrantable status means the property does not meet the minimum financial and structural lending standards set by government-sponsored mortgage buyers. When that happens, prospective buyers can no longer secure standard conventional mortgages to purchase units in your building. Without access to typical financing, your buyer pool shrinks strictly to cash investors, and the property value of every unit in the building drops significantly. These new financial regulations are a direct response to a physical tragedy. Following the 2021 collapse of the Champlain Towers South in Florida, regulators determined that underfunded condo reserves and deferred maintenance pose severe safety and financial risks to lenders and owners alike. To keep your building compliant and protect your equity, we are going to build a 4-step Warrantability Action Plan. We will outline exactly what your HOA needs to do to survive the upcoming 2026 and 2027 deadlines. Step 1 is gathering your current documents. Before we execute the plan, you need 3 specific files from your property manager: your current HOA operating budget, your most recent reserve study, and your master insurance declaration pages. Securing these documents and proactively restructuring your finances is the only reliable way to navigate this bureaucratic shift and defend the personal equity of every owner in your community. The first part of our action plan addresses how lenders review your building. For years, many condos relied on a limited review process, a streamlined shortcut that skipped heavy financial audits. For all loan applications dated August 3, 2026 or later, that shortcut is officially retired. Without the limited review option, any condominium project with 11 or more units will be subjected to a full review. Lenders will scrutinize your operating budgets, structural engineering reports, and delinquency rates in deep detail before approving a loan. This flowchart shows the new review pathways. If your building has 10 units or fewer, you qualify for a waiver of project review. This waiver bypasses the heaviest financial documentation requirements, allowing small associations to maintain loan eligibility with much less paperwork. There is also immediate relief available for the Florida condo market, which has historically faced the strictest lending penalties. Fannie Mae has eliminated the restrictive Project Eligibility Review Service, or PERS, for new Florida condos. This removes the old rule that forced Florida buyers to put 25% down, allowing them to return to standard nationwide lending terms with down payments as low as 3 to 5%. Knowing whether your building faces a full review or qualifies for a waiver tells you exactly how much documentation you need to prepare and dictates the level of friction your buyers will face at the closing table. The second step of the plan tackles your community's savings. Starting January 4, 2027, Fannie Mae and Freddie Mac mandate that your association's reserve contributions must equal a minimum of 15 when the reserve slice expands to 15. However, to use this exception, your annual budget must exactly match the highest recommended funding level outlined in that reserve study. You cannot pick a lower funding tier to save money. You must also ensure your study does not rely on baseline funding. Baseline funding is an accounting method that aims to keep the cash balance just above $0. Under the new rules, relying on a baseline funding model is explicitly banned. Failing to properly allocate these reserve funds by the 2027 deadline automatically triggers a non-warrantable status. If the reserves are short, unit sales are cut off from conventional financing. Step 3 of the action plan is calibrating your insurance. This graphic shows the new limits. The Master and HOA property insurance policy can carry a maximum per-unit deductible of $50,000. The agencies did provide some relief to HOAs struggling with soaring premiums. Buildings can now use actual cash value coverage for their roofs, meaning the policy pays out the depreciated value of the roof, rather than forcing associations to buy expensive full replacement cost coverage. If your master policy carries any deductible at all, it triggers a requirement for the individual unit owners. Every owner is now required to carry a supplemental HO6 policy to cover the gap left by the master deductible. An HO6 policy is standard condo insurance, covering the unit interior and personal liability. For these policies, the deductible is strictly capped. It cannot exceed 5% of total property insurance coverage or $2,500, whichever is higher. By setting these specific deductible limits, lenders ensure neither the homeowners association nor the individual owner will face ruinous out-of-pocket costs if a disaster strikes the property. Step 4 is organizing your defense. Because nearly every sale will now trigger an intense full review, your board must compile all compliance documents into a single centralized digital repository. We call this the Warrantability Vault. Inside this vault, you need to store your financial proofs. This includes the newly audited operating budget showing the 15% reserve allocation and your updated reserve study proving you do not rely on baseline funding. Next, add your insurance documents. Upload the master insurance declaration pages that prove the building's per-unit deductible remains under the new $50,000 limit. Finally, load your structural documents. You need recent board meeting minutes and engineering inspection reports that clearly prove the building has no unaddressed critical repairs or active evacuation orders. Your property manager must have this vault ready to go. The moment a unit in your building goes under contract, the manager needs to instantly share the secure link with the buyer's lender. Having these files pre-organized shifts your association away from a defensive scramble. Building the vault ahead of time creates a proactive system that guarantees market liquidity for the owners. Identifying your review pathway, auditing your reserve contributions, capping your deductibles, and building your document vault. Executing these 4 steps provides a complete defense against the new lending guidelines. The clock is already ticking on community compliance. The retirement of the limited review process hits on August 3, 2026, and the strict 15% reserve mandate takes effect on January 4, 2027. To meet these deadlines, you need to distribute this action plan immediately. Send this out to your HOA board president, your property manager, and your reserve specialist so they can begin restructuring the upcoming 2026 budget today. Mastering these bureaucratic changes takes work, but it is the ultimate tool for preserving your community's wealth, maintaining its structural integrity, and ensuring its survival for decades to come.